if you've got a certain goal or an objective or a target, you might turn around and say, yes, wanted to help our children, get into property by the time they're adults or what have you. You pick a target amount, you work your way backwards, and then figure out, an estimated rate of return. You figure out what you're going to need to contribute, and something like this, free cash flow or freer cash flow from an interest rate decrease, you might turn around and say, okay, we're going to contribute that towards this because that's what's it's going to get us to.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello, welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are, back again.
Back again, Andrew, in the recording studio. Favorite time of the week, bringing a whole heap of value to our listeners and our viewers. Andrew, it looks like you're dressed for the Alps.
I am. It's cold in Melbourne and we've had no autumn. We went from mid 20 degree weather to low teens overnight, and so I'm freezing. Haven't had a period to ease into it.
Yeah.
And this European person living down in Australia, just the European genes, it doesn't work.
Fair enough. Well, look, hopefully there's something that we're going to talk about that's going to warm everybody up, because I absolutely love this topic. Andrew, let's get into it. What are we talking to everybody about today?
Yeah, so, look, probably have to be living under a rock to have not realized or not heard that interest rates have come down. And so today we're really going to talk to mortgage holders. We're going to talk to mortgage holders and say, great, okay, interest rates have come down. What does that mean? What do I do? How do I actually, capitalize on that? And aside from the obvious benefit of paying less interest on your mortgage.
Yeah, and the reason why I absolutely love this topic is because a lot of the people that we deal with every day in our financial advising lives is people with mortgages. And if you consider the amount of, from a cash flow perspective, the amount of strain and the amount that your mortgage takes out of your cash flow, it's quite significant. So anytime that there's an opportunity to be able to pay less interest or do some strategies to be able to pay the loan off quicker, I get really excited by it. And that's what we're going to cover off on today. Andrew, where do we start? Maybe we just do a quick recap in terms of why the rates have gone down. Just give us some economic reasoning behind what we've seen and why the Reserve Bank of Australia have decided to do that.
Yeah, look, the main reason is inflation. That's been the primary driver. So you see inflation come down within that band of 2 to 3%. Obviously, we've come off the back of a period of time where inflation was exorbitantly high post-COVID. That started to come in line with where expectation is. GDP forecast and outlook for GDP has also been slowing a little bit. So really the main driver is to create some economic stimulus to really start things moving again. The RBA's decided to bring interest rates down.
Good sign.
Yeah.
And plus, if we look forward a little bit as well too, just depending on which economist that you talk to, there's consensus that we can expect at least another 2 this calendar year, if not 3, with the next one coming at the next RBA meeting as well too. So fingers crossed, we'll wait and see. I think there's more to go with this story, but look, let's take it. Talking through some of the things that we should think about when this happens. It's great and it's a nice, I don't know if we'll call it a free kick, but let's call it a free kick. But what do we do? What's the first thing that we should think about as mortgage holders when this does happen?
Yeah. So I guess, look, the first step is making sure that you're actually maximizing what that interest rate reduction is. And what I mean by that is not all banks will always pass on the full rate cut. So just because the RBA reduces rates by, 25 basis points, or maybe at some point in time they do it by 50 basis points, you need to review your mortgage. You need to review and make sure that the lender is actually passing that on. And if they're not, is there a better rate out there? Is it worth refinancing? Bearing in mind, if you do refinance, we have spoken about it many times on the podcast, but don't reset your loan term to 30 years if you're, 25 year, or if your loan term is now 25 years, because yes, you might be getting a better interest rate by refinancing, but if you're then going to extend your loan term out, you're going to end up paying significantly more interest. So have some consideration as to, it's not an easy process. You're not going to jump around banks every month, but make sure that your interest rate is actually still competitive.
Yeah. And look, there's a lot of choices these days. There's so many lenders that are on the market. What I found interesting actually with our business is when we were looking at the rate cut, in terms of how long it took each individual bank and lender to pass those on, there was a huge variance between them all. And, you look at it and you go, hey, this is a bit cheeky, right? They're trying to push it back further and further and further, and you're just trying to gouge your customers. And I get it. They've got a business to run, has to be profitable. But yeah, there is a lot of lenders out there, but you just need to be mindful, look a little bit deeper into it, make sure that you're on something competitive. And yeah, like what you said, be mindful of resetting the loan term, because that seems to be the norm whenever a loan does get refinanced. And then before you know it, if you're not making, or if you don't have an accelerated debt elimination program, then you might have a loan for longer than the original 30 years and still find out that you've got a long period to go, and it could be quite a shock for some people. So that's a really good one. What I tend to think is really low-hanging fruit is if you're on a variable interest rate, your rate obviously will come down, but your repayment will go down to match whatever the deduction is. In this instance, it was 25 basis points. One of the things that I found really easy to do, if you overlook it, is that your repayment will automatically reduce each month, or whatever the repayment term is. And obviously you're getting the free kick of the reduced cash flow each and every repayment. But in saying that, it might be substantial. It might be $50 a month, $100 a month, whatever it is, depending on your loan size and what your interest rate is. But I feel like it's a really easy one that if you maintain your repayments, if you maintain the status quo, you're not kind of, you're getting the benefit of the rate cut, but you're not doing anything from a cash flow perspective. So your cash position, your expenses have stayed the same. And what it does end up doing is that additional money that you're putting in, call it $100 a month, that works as an extra repayment. So when you work that out over the life of the loan, it's a substantial difference. So to sum all of that up, if you can keep your repayments the same when they decrease, I think that's absolutely fantastic, because automatically you're making additional repayments. And I'd argue that that's a lot more powerful and easier to digest, and it doesn't really impact you too much. But the difference that it can make substantially over the long term is absolutely huge. And it's kind of, we talk about lifestyle creep. When somebody gets paid more, they end up spending more money. I think this is the same thing, but doing it in reverse. So it's a good way to control it, and a good way to get a fairly easy free kick and move the needle quite substantially over the years.
Yeah, which does, brings us to the next point, and sort of ties in with that, was, looking at what your loan structure is like. Were you on a fixed rate, or are you on a variable rate? Is it worthwhile fixing it? If the expectation is that interest rates are going to come down unless you can get it for a significantly lower rate, maybe that's not the case. But when you start talking about offset, redraw, and that status, a lot of the times we'll have a conversation with a client and you'll say exactly that, which is keep your repayments the same, and, make sure that you're just paying down the loan quicker as interest rates start to come down, because you pay off more of the principal. Now, some of the strategies that people choose to deploy is, hey, I'm not going to pay the loan down quicker. I'm just going to leave that extra money in my offset account so that I've still got access to it. The trouble with that is, if you're leaving it in the offset account, the temptation to spend it is there, and the likelihood that that's going to go into a lifestyle creep and you're essentially just going to spend a little bit more money is relatively high. So if you don't have a really good structured cash flow strategy, leaving it in the offset account could mean that you're just eventually going to end up spending that money anyway. So review your loan structure, review your cash flow and budgeting strategy, and look at, okay, what am I actually doing with this, and how do I make sure that I stick to it? Because it's all good and well to say, hey, my repayments are, $3,000 a month, and interest rates have come down, so my repayments are going to go to $2,900 a month. I'm just going to, do nothing because I'm going to have an extra $100,000 a month in my offset account. And it's okay, well, if you're not careful about it, and if you're not actually building a strategy around it, that $100 extra a month in your offset account is very easy to, be spent on one extra dinner a month.
Yeah, no, you're absolutely right. One of the things that we do, and it's exactly what you've described, but there's also another additional element to it, and it comes around sort of cybersecurity type of stuff. So in terms of how we've got our mortgage structured, we've got our offset account, but we've got a loan product that allows multiple offsets. So what I've got is I've got an offset account that money comes into and out of. That's got a small amount of money in there, and that's where we pay certain bills and bits and pieces. And then we've got another offset account, which is where the bulk of our money sits in offset. That one there, that gets money put into it from the offset that receives the income. This would be so much easier with the whiteboard, Andrew, that receives the income. So the main offset account is continually growing, but it's kind of like out of sight, out of mind. Yeah, we don't see that, hey, there's tens of thousands of dollars in there. We're tempted to take a little bit out and go and spend it. The other flip side with that is the main offset account that receives the income is only a relatively smaller amount of money in there, because that's the one that you can transact out of. Because all of the settings that we've got set up with the bank is we can only do interbank transfers and can only transfer externally from that main offset account. So it serves two purposes. One, from a security perspective, because I'm always paranoid about that. And the second thing is what you were describing, is keeping the bulk of the offset money separate, so you don't see it grow and then all of a sudden you think, hey, we've got some extra cash here, and you go and spend it.
Yeah. And I think that is, you consider it, and it's the big thing that I'd stress in this is review your cash flow and review your budget and decide on what you're going to do with that additional cash flow. Because if you're not deciding, then it's too easy for it to just, great, there's an extra lunch a week. And is that really making any difference to your lifestyle, or is that just, something that's happening because you feel like you have a little bit more money? So make sure that you're utilizing that savings wisely. Now, one is, exactly what we've been talking about, which is reducing your mortgage. Make sure that you're paying off your mortgage even quicker because you're paying less interest. But sometimes the strategy is, hey, let's add that additional surplus income into superannuation contributions, right? If you salary sacrifice, let's say $100 into superannuation, because that's where your mortgage reduced by $100, you're getting the benefit of one, additional money into super, invested, grows, compound interest, all of that fantastic stuff. But then you're also compounding that benefit in a tax deduction, because at the same time, you're also making a tax deductible contribution into super. So it's reducing your taxable income, which is then further increasing your cash flow position in future years, because you're, in essence, paying less tax as a result of it.
Yep.
Maybe it's that. Maybe it's, putting that money into a growth bond because, you want to send your kids to private school, or you want to save up to, eventually help them out with a deposit when they turn older. Maybe it's utilizing that to, further your investments and put more money into your investment account. Maybe it's to build up another savings account or increase your savings to buy an investment property. But decide on what your cash flow position is going to be, or determine what your cash flow position is going to be, decide on what your wealth strategy is going to be, and help use those funds to go towards it. Because, okay, one interest rate cut, maybe it goes into a lifestyle creep, maybe it's not that big of a deal, but you consider and say, we've already had a couple of interest rate cuts, we're expecting that there's going to be 2, maybe 3 more. If that is just increasing your lifestyle, doesn't seem like very much month on month.
Yeah.
But you look at start period to end period, and you could be talking about, $500-$600 a month, which makes a huge difference in an investment journey at the end of it, if you're putting in the strategies and structure from the very beginning.
Yep, I completely agree. Sort of back to what I was talking about before about making the repayments the same after the interest rate cut. So don't decrease your repayments, keep them where they were. It's the same thing, I guess, the other way as well too, is from a lifestyle creep perspective. So basically saying, okay, we've got additional income in the household, and what do we do with that? We actually spend it. And not only do we spend that, maybe we feel wealthier. So the wealth effect is taking an impact. or having an impact and then influencing us and going, okay, there's a little bit more spare cash flow, so we're going to use that, plus we're going to use a little bit extra. All of a sudden, we've gone and taken our usual expenses from here to here. It can actually have a really detrimental effect as well too. So you need to pay attention to these things, because you don't want to get caught out with the fact that you're going to feel wealthier because you've got more money floating around, and then you basically spend that, but then you spend a little bit extra as well too.
And on the flip side, right? So it doesn't always have to be something for a financial benefit, which seems like a weird thing coming from your financial advisor, right? So, okay, there's, let's say, some additional money that's coming into the household as a result of it. Well, maybe for the last 2 years, while interest rates have been going up, you've felt the pressure, your cash flow has really been squeezed, and you've decided that, hey, well, we can't afford to go on holidays anymore. And, that's just what we have to do in order to continue doing all of the other stuff. Or make a rational decision. Because if you're not, holidays is obviously not a, financial benefit or anything that's going to give you a financial benefit. But take that extra cash flow, put it into, another offset account like Billy suggested that sits against your mortgage so that you're still, offsetting your mortgage and separating that out, and put that, $100 a month or $150 a month, whatever that number is, maybe a portion of it goes towards a holiday savings account where that's going to build up over time, and eventually, in a year or two, then you can start introducing a holiday every year or two. So it's making a rational decision with it and having a strategy behind it, because if there isn't, it's too easy for it to just slip through your fingers.
Yeah, and look, I mean, we're advocating for advice on every single episode, and I think this is just another example of that, is basically saying, okay, what does it look like in terms of my broader financial consideration, my broader financial circumstances, and even thinking through, let's say for argument's sake, you've got, your debt elimination strategy and you're comfortable with that. So you decide that from a cash flow perspective, now that it's been freed up because interest rates have decreased, you're going to use that money elsewhere. So think about what you're going to have, where you're going to put it, investing, topping up super, building wealth, what have you. But once again, and this is, I guess, how we build strategies, and we've spoken about this on the podcast before, is basically saying, okay, if you've got a certain goal or an objective or a target, you might turn around and say, yes, wanted to help our children, get into property by the time they're adults or what have you. You pick a target amount, you work your way backwards, and then figure out, an estimated rate of return. You figure out what you're going to need to contribute. And something like this, free cash flow or freer cash flow from an interest rate decrease, you might turn around and say, okay, we're going to contribute that towards this because that's what it's going to get us to. And from an advice perspective, when we're putting it together, we are looking across the whole spectrum of somebody's circumstance. So it's not necessarily just, hey, the automatic answer is accelerated or continue to put it into the mortgage, because we might already have that strategy on track. And it could provide an opportunity to be able to open up, something else that wasn't there previously. Especially if we're talking, 4 or 5 rate cuts, it can get quite significant depending on what your loan amount is.
Yeah, and on that, I mean, maybe the strategy is completely different. So you might look at it and say, hey, off the back of 3 rate cuts, where previously we could borrow X amount, and our serviceability, to be able to get a mortgage was only to a certain level, maybe upsizing the family home where it 3 months ago wasn't an option, now is an option, and we can bring forward a strategy that, was going to happen in a few years' time. Maybe, an investment property was a stretch at the start, and now an investment property, because borrowing costs have come lower, is now an opportunity. So I think that the big key takeaway is, whenever there's a change, understand, okay, is the change a change in circumstance or a change in goals? If it's a change in circumstance, then it's, okay, well, what does that do in my ability to meet my financial goals? Does it bring things forward? Does it push things back? Does it make things more challenging? Does that open up new goals? So just constantly having an idea of, okay, well, with this change in circumstance, what do we do with it, and how do we then structure it to make sure that we're still moving towards the direction that we want to move in?
Yeah. Or if that all sounded too complicated, the strategy is get advice.
Yeah.
Because I think
that's always the strategy, Bills.
It's always the strategy, and we're just talking to people about ideas and stuff that we consider as part of kind of engagement, right? So, look, I think we, did that one justice. It's pretty exciting that we're seeing rates starting to, continually come down, which is great for mortgage holders, because it's been the opposite for a while, and it's good to see that it's happening, and it's exciting because it does give households opportunity, and hopefully, as a collective, we can capitalize off that opportunity, and it's not just, some relief and go, okay, it means that, it takes less pressure off everywhere else. I'm sure that is happening because the cost of everything is so expensive. But, like what we were talking about before, I think getting advice is probably a good place to start.
Yeah. Bills, well summarized. I think that does that episode justice. To our viewers and our listeners, if you got some value out of that one, like and subscribe. It really does make a difference to us, and share it across to family and friends. And we look forward to catching you on the next podcast.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.